Good afternoon. It's my real pleasure to welcome you to this afternoon's event on the debt challenges of the emerging market. And it is my particular pleasure to welcome our distinguished panel of experts to help us better understand the issues. I should just mention at the outset that unfortunately, Carmen Reinhardt has been unable to join us this afternoon. However, I'm pleased to say that someone as distinguished and with as much official experience on the emerging markets as Mark Sobel has graciously offered to join us in our panel at the very last moment. Allow me to introduce the panelists in the order in which they'll speak. Our first speaker will be Ian Kose, who's Acting Vice President of Equitable Growth Finance and Institutions at the World Bank. And he's also responsible for the World Bank's work on global macroeconomic outlook. Our second speaker will be David Lubman, who is Managing Director and Head of Emerging Market Economics at Citibank. Our third speaker will be Mark Sobel, who is the US Chairman of OMFIF, and he formerly represented the United States at the International Monetary Fund as the Executive Director. Mark has also had extensive experience with emerging markets in his former role for many years as US Deputy Assistant Secretary, Treasury for International Monetary and Financial Policy. And last, but by no means least, is my colleague Steve Kamen, who is a resident fellow at the AEI and who was formerly a director of international finance at the Federal Reserve. Just by way of introduction to today's discussion, I thought I might note that over the past decade, the emerging market economies have come to play an increasingly important role in the global economy. Not only have they been the principal engine for world economic growth over the past 10 years, but they've also now account for more than half of the world's output. They've also been the recipient of massive capital flows from the advanced countries over the past 10 years. This has occurred as investors have stretched for yield in an environment of ample global liquidity created by the highly unorthodox monetary policies of the world's major central banks. According to the Bank for International Settlements, they made an estimate recently that these flows have resulted in a rise in the amount of US dollar denominated debt of the emerging markets now to more than $4 trillion. So we're talking about a very important part of the global financial system. The COVID pandemic has very much clouded the economic outlook for the emerging market economies in much the same way as it's done for the rest of the world. These economies are all at the same time now being hit by an economic shock that has included for them major decline in international commodity prices, a contraction in their export markets to the advanced economies, and a reduction in workers' remittances. So they really have been hit by a perfect economic storm. This has prompted the IMF to forecast that the emerging market economies will contract by more than 3% in 2020. And if you exclude China from that picture, we're talking about a decline in output of 6% for the emerging markets, which would represent by far their worst economic performance in the past 90 years. It's also not helped matters that many of these economies went into the crisis with very compromised public finances and with record high debt levels. That in turn has limited their room for policy maneuver, and it has raised serious questions as to whether these economies will be able to avoid widespread debt defaults and restructuring in the period ahead. This would seem to be especially the case were we to have a second wave in the pandemic, as now seems to be occurring in both the United States and Europe. All of this would suggest that in the period ahead, the fortunes of the emerging market economies will have an important bearing on the world economic outlook, and on the stability of the global financial system. For this reason, I thought it timely to have an AI event that focused on an important topic that all too often does not get the attention that it deserves. And it's for this reason too, that I'm particularly pleased that we have a panel of real experts to help us better understand the debt challenges now facing the emerging market economies. In organizing the seminar, I've asked each of the 4 panelists to speak for around 10 to 15 minutes on one of the following 4 questions. So first, we'll have Ian Cozy, who will address the question of how is the currently expected experience of debt defaults in the wake of the pandemic likely to differ from that which followed the 2008-2009 Great Economic Recession. Next, we'll have David Lubin address the question as to which of the emerging markets appear best placed to weather the COVID storm and which ones appear to be the most vulnerable to a deepening of the global economic recession. Third, Mark Sober will address what is the appropriate role of the IMF to help these countries navigate their debt challenges and what steps need to be taken to improve sovereign debt workouts. And last, Steve Kamen will address the question as to what is the outlook for the emerging market economies to access the global capital market in the year ahead. Should there be a normalization of monetary policy in the advanced economies? So with those introductory words and without further ado, I'll turn it over to Ian to address the first question. How does the current emerging market debt experience differ from 2008, 2009? What is the World Bank's perspective on this issue?
Thank you, Desmond, and it's great to be here at the American Enterprise Institute. It is virtually, and I'm very happy to share the stage with this distinguished group of panelists. And I think if there is a time to talk about debt issues, this is the time. What I plan to do in my initial remarks, put this issue in context, tell you about the kind of the views we have on the state of the global economy and how we see the debt problems in emerging market and developed economies. So let me start with the kind of the perspective on the outlook. The pandemic has tipped the global economy into its deepest recession since the Second World War. This is the first global recession driven by a pandemic. 90% of global economies are expected to contract this year. This 90% is even higher than what we saw during the Great Depression. In the context of emerging market developing economies, unfortunately, this episode also marks a milestone. This is the first time since at least 1960, emerging market developing economies output as a group is expected to contract this year. Now, relative to the global financial crisis, we have an episode in our hands at least 2 times deeper. And we had much larger policy stimulus put in place. And that policy stimulus averted, I think, a financial crisis, at least so far. And this is a lesson learned from the 2008-2009 episode. Major advanced economies have implemented considerably larger fiscal stimulus packages after the kind of what they did in comparison with the global financial crisis. Many emerging market developing economies have also provided sizable fiscal support. When you look at financial markets, we didn't have the type of course, the disruption. The 2009 episode was a financial crisis. This started as a health crisis. But what we saw in financial markets, supported by advanced economy central banks cutting policy rates or expanding or extending their quantitative easing programs. They were joined by more than a dozen emerging market developing economies that also introduced quantitative easing programs often for the first time. So there is significant liquidity in the system provided by central banks, major central banks around the world, keeping financial stability. As a result, parts of the global economy have rebounded quickly once some of these pandemic-related early restrictions were eased. Other parts are unlikely to recover before the pandemic is brought under control. So a second wave of infections risks derailing this recovery, now what we see. Let me turn to the kind of the risks. Even if the recovery proceeds as we anticipated in June, there would be considerable output losses. Under the baseline scenario we have, global output in 2025 would still be about 5% below the pre-pandemic trend. A more protracted pandemic than expected could lead to even larger income losses and lead to financial market stress. Delays in vaccine development could disappoint still sanguine financial markets and trigger a repricing of risks. As you mentioned, there is a record high debt. Higher borrowing costs could tip many corporates into bankruptcy, weakening balance sheets to an extent that triggers a financial crisis. And the output losses from such a recession combined with a financial crisis would be long-lasting. So let me talk a little bit about the debt issue and get to the kind of the bigger question we have today. Even prior to the pandemic, starting in 2010, we were experiencing a major wave of debt accumulation. This was the fourth wave that was underway with the largest, fastest, and most broad-based increase in global debt we saw in the past 5 decades. Global debt had risen to a record high 230% of GDP in 2019, and government debt was at a record level close to 85% of GDP. In around 80% of emerging and developing economies, debt was higher in 2019 than in 2010, and in half of them, it was actually 20 percentage points of GDP higher. Now, I said the fourth wave of debt accumulation. There's a reason for that. This fourth wave was preceded by 3 previous waves since 1970s. And it's very important to understand what happened during these waves and how they ended to basically shed light on the conversation today. These 3 waves ended with widespread financial crisis. Take the kind of the first wave of global debt that spanned the 70s and 80s with borrowing by governments in Latin America and in low-income countries, particularly in sub-Saharan Africa. This wave saw a series of financial crises in the early 1980s. The second wave ran from 1990 until the early 2000s as banks and corporations in East Asia and the Pacific and governments in Europe and Central Asia borrowed heavily. This wave also ended with a series of financial crises in these regions during 1997-2001. The third wave was a run-up in private sector borrowing in Europe and Central Asia when you think about emerging market developing economies, of course, as well as in advanced economies, which ended when the global financial crisis disrupted bank financing and tipped several of these emerging market economies into sharp recessions. Now, we are going through the fourth wave of debt accumulation, and this wave shared several features with the previous 3 waves. A low interest rate environment, the emergence of new financial instruments or financial market actors, and a protracted period of weak investment and slowing growth despite surging debt. Even before the pandemic, as you touched on, there was no room for complacency. Previous crises had frequently been triggered by exogenous shocks that resulted in a sharp increase in investor risk aversion and sudden stops of capital flows. Global growth slowdowns were often catalysts for crisis. So here we are in 2020, we had a pandemic, a deep global recession. And of course, these are the types of episodes, the slowdowns, recessions that trigger financial crisis. So the global economy is more vulnerable today to financial stress than before, or even immediately after the global financial crisis because of record high debt. In 2020, global debt stocks are expected to leap by another 14 to 16 percentage points of GDP. This surge in 1 year, in 2020, is going to be one of the largest and most broad-based we have seen in history. And we already have seen significant debt distress in some frontier market economies and poorest countries around the world. To take a first step toward debt relief for the poorest countries, the World and the IMF, as you know, proposed a moratorium on debt payments by the poorest countries. This was partly a response to COVID-19, but at the same time, it was a response to the need for countries to have fiscal space and also a recognition. This is very important, a recognition that a debt crisis was underway for the poorest countries. With endorsement by the G20, G7, and the Paris Club, the Debt Service Suspension Initiative, or DSSI, took effect on May 1st. It enabled a fast and coordinated response to provide additional fiscal space for the poorest countries in the world. As of now, we have 44 countries who are benefiting from an estimated around $5 billion in debt service suspension from official bilateral creditors, complementing the scale-up emergency financing we are providing and the IMF is providing. But the SSI is simply a stopgap measure. It does not address the debt challenges of these countries. First, too many of the creditors are not participating, leaving the debt relief too shallow to meet the fiscal needs of the inequality and the deep contraction triggered by the pandemic. Second, debt payments are simply being deferred, not reduced. So it doesn't produce a light at the end of the debt tunnel. Now, why are we worried about the problems in emerging market developing economies, especially in the poorest countries? The story is different than the 2007, 2009 global financial crisis. That was a systemic financial crisis felt in a number of advanced economies. And as I mentioned, the Europe and Central Asia emerging market economies in the form of debt crisis, the balance of payment crisis, the currency crisis. Here, at the moment, we are talking about a small set of the poorest countries, but still, we need to worry because down the road, we might see different types of risks emerging, which I'm going to talk about very soon. But it is important to understand what happens following these types of rapid debt accumulation episodes. We studied these episodes, like the one we have been going through. Since 1970, at the country level, there have been around 520 episodes of rapid private and public debt accumulation in about 100 emerging developing economies. About half of these episodes were accompanied by financial crisis that led to severe output losses. So when you have rapid debt accumulation, the type of accumulation basically we have seen over the past decade, amplified by, of course, now the COVID emergency, 1 out of 2 cases, you hit a wall and you end up with a very serious financial crisis episode. Now, there is an important lesson we should take from the global financial crisis. It was followed by a decade of weak growth. All fundamental drivers of growth faded, investment was anemic, productivity growth slowed. Of course, after the global financial crisis, at least the global recession of 2009, we saw a rapid rebound in 2010. But then, soon after, we had the Euro area crisis, we saw bouts of volatility. We had a collapse in oil prices, and then, of course, the financial stress in 2018 in some emerging markets. That episode also was followed by a decade of repeated growth downgrades in terms of the short-term and the long-term growth forecasts. This disappointing decade has been dealt a final blow by the pandemic. And the pandemic-induced global recession has turned the 2010s into a lost decade for many emerging developing economies. In roughly 30% of these economies, per capita income losses in 2020 have reversed 10 years or more of gains. In more than half of these economies, at least half a decade of income gains has been reversed. As a result, we saw an increase in poverty rate for the first time in 2 decades this year. The debt challenge emerging market developing economy is facing is a formidable one, and it's a historical one. In the past, when we did not address these types of debt problems and kick the can down the road and employ tactics involving extending and pretending the pain, we always ended up with lost decades. We had it with Latin American debt crisis. We had the same problem with the crisis of low-income countries. This time, global community can address this issue at its roots rapidly and permanently. And that's our hope. But let me stop there. Thank you.
Thank you very much, Ian. Before I turn to David, might I just ask, you've painted a rather dark picture for the emerging markets. What is the kind of implication that this has for the rest of the global economy? That if we get to get a debt workout, whichever way we slice it, there are going to be very big losses that are going to have to be distributed around the rest of the world. And what my concern would be is that the emerging markets crisis is not playing out in isolation. We've got many other parts of the global financial system that are very stressed, that whether it's the US high yield leveraged market or whatever, we're talking about trillions of dollars of different assets that are all stressed at the same time. So my question is, how do we work this out, without taking the global financial system down?
Thank you, Desmond. And I think that's a very important issue we need to address head on. The type of debt problems we are discussing today, the immediate debt problems we are focusing on in the context of the DSSI initiative as well, basically focus on the poorest countries. Will the kind of the problems of these economies translate into a systemic episode with very large spillovers to other parts of the world? At the moment, I don't see that as a strong possibility. Okay, that's very important. But when we have these types of deep contractions, we have this tendency that this will pass, we are going to go back to normal, and nothing will happen for a while. Things will be smooth. We don't have to go back further than the last global recession, 2009. We had a rather strong growth episode in 2010. 2 years later, we had a euro area debt crisis, which pushed the Eurozone to the brink of collapse. If you go back to the previous global recession, 1991, that ended. And then soon after that, you had banking crisis, ERM crisis, a major set of financial stress episodes. So whenever you have a big hit to the real economy, you need to worry about the kind of the shocks that will follow. And that might not happen during the next 6 months, that might not happen during the next 12 months, but we should worry about what will happen during the next 24 months. we should welcome the very large fiscal packages to address the health crisis. But we should be mindful of the fact that in the context of emerging market developed economies, sooner or later, there has to be a well-defined medium-term strategy to address the sustainability concerns. So if we see large emerging markets having debt challenges, of course, that will have immediate short-term adverse impacts on the global economy, and that will be a very, very serious situation.
Thank you very much. David, that's a good segue into you, to perhaps let us know, which are the ones that are doing better. What is the outlook as far as you see it for the emerging markets? Which ones are the more challenged economies?
Thanks very much, Desmond. I mean, if you're looking for good news in the economic environment in emerging markets, it's easy to find it. It's in China. China has enjoyed an extraordinary success in controlling the virus. And its economic activity has been supported by, I think, two things. The first is that while China's trading partners have been busy supporting consumption through income support and furlough schemes, China's economic policy has been focused on supporting production, getting people back into factories. And so when you combine these two things, China's trading partners supporting consumption, China itself supporting production, the result is a fantastic recovery of Chinese exports, which has been reinforced by the fact that China makes a lot of medical equipment and PPE and tech goods that have been in high demand during the course of 2020. The second feature of China's extraordinary economic performance this year is the application of what you could describe as a kind of traditional credit stimulus. I say it's traditional in the sense that we've seen this on two occasions in the last 12 years. In other words, where China has in the past delivered a credit stimulus. The first was in the years following the global financial crisis between 2009 and around 2012. And then the second was in 2016, 2017. And these credit stimulus episodes that China embarks upon are incredibly important because the credit stimulus, the sort of what I call the traditional Chinese credit stimulus, is an investment-focused credit stimulus. It's designed to support investment spending in the Chinese economy. And that's what we see in 2020. Real estate and infrastructure are the two parts of the Chinese economy that are most responding best to this stimulus. Now, that not only helps China itself, but can be incredibly supportive for other emerging economies. And the reason for that has to do with the huge role that the Chinese economy plays in shaping changes to the global investment cycle. Between 2010 and 2018, China, on average, during those years, was responsible for around 60% of global investment growth. So the global investment cycle is kind of China-shaped. And that's an important fact because the global investment cycle kind of determines the global commodities cycle and it determines the global trade cycle. So if you're a commodity-dependent economy, if you're an open economy, you are therefore a China-dependent economy. And so the credit stimulus, the investment-oriented credit stimulus that China has been putting together during 2020 has been very supportive for countries like South Africa and Brazil. I think one of the reasons, surely why in the last 6 weeks or so, market participants and economists have stopped downgrading Brazilian growth forecasts is because of the recovery of global commodity prices that is largely the result of this Chinese stimulus. Now, in the last 12 years, China has had effectively, or the last 10 years, China has had effectively two conflicting economic policy objectives. One is to support the economy, and the other is to avoid a financial crisis. It can't achieve those two objectives simultaneously. And so what we've tended to see in China over the last decade is a kind of pendulum swing, so that there are occasions when China is focusing on delivering credit stimulus to the economy, and then there are occasions when China is emphasizing deleveraging and the pursuit of financial stability. The very good news at the moment is that China may have resolved the dilemma. And the way in which I think they may have resolved the dilemma is that the Chinese have managed to kind of separate the price-based analysis of credit from the quantity-based analysis of credit. What I mean by that is that interest rates, i.e. the price of credit, have been going up since May. So when you look at the credit market through the lens of the price of credit, things look quite hawkish. But when you look at the flow of credit, total social financing, and the size of the credit impulse that China is delivering, the quantity of credit looks kind of dovish. This splitting of the price and the quantity of credit is, I think, an attempt by China to kind of have its cake and eat it. They've raised the price of credit to A, control the growth of shadow banking, and B, to catalyze a capital inflow to stabilize the balance of payments. And in that respect, they've been quite successful. So if they've managed to find their way to have their cake and eat it, that's great news, not just for China, but it's also great news for other emerging economies and other open economies. And there might be a kind of political economy reason to think that China might want to sustain the stimulus going into 2021, because in July next year, the Communist Party celebrates its 100th anniversary, an incredibly important symbolic moment for the Chinese Communist Party. And so you might think, in a kind of political business cycle type argument, that China may want to kind of keep everything looking nice and shiny during the course of the first half of 2021. All of that's good news. And now everything else that I'm going to say is bad news. Because in spite of this, the application of this Chinese stimulus, there is, I think, a deep long-term growth problem in emerging markets with which this Chinese stimulus is not going to remove. In the longer term, China itself is becoming increasingly EM unfriendly, because China is engaged in a long-term transition towards a consumption-led economy, and emerging economies don't sell consumption-related goods to China. So the more that China pursues this transition, the weaker China becomes as a kind of source of support for EM demand. The rise of global protectionism, which we've been able to identify going back to 2012 or 2013, is also a serious long-term threat to emerging markets growth. And there are demographic challenges in Central and Eastern Europe, in North Asia, in parts of South America. And there's also the problem of the increase in debt itself. We're used to making the argument that weak growth raises the debt GDP ratio because the government's capacity to tax goes down and its obligation to spend goes up. But the causation works the other way. As debt has increased across the emerging world, I think that acts as a kind of tax on potential growth. And so all of these things make me think that the growth outlook for emerging markets, which was pretty lousy actually before coronavirus, is made even worse by the crisis that we're currently in. If you add that to a number of other factors that I just want to set out, then you get to the sort of the policy environment that countries are facing now. So the package of factors that I think is relevant at the moment is, first of all, the fact that potential growth in emerging economies is in some ways in a sort of state of long-term decline. The second is that the upward shock of the debt GDP ratio in 2020, the public sector debt GDP ratio, which on average is rising by 1,000 basis points across developing countries, represents a deterioration in the risk profile of these countries. And that, as I said, in turn is some kind of longer term threat to growth. A third factor that I think is relevant is that belt tightening, which of course is a ridiculous idea in 2020 when you're faced with a grotesque economic crisis which has humanitarian dimensions. You want to finance a deficit. You don't want to adjust the deficit. You don't want to tighten your belts in an environment like this. Having said that, I think that an unwillingness to tighten belts may be a lasting legacy of this crisis. And therefore, a government's financing needs may be sustained well beyond this crisis. And a final factor that I want to mention, just to put everything together as I see it, is that for many emerging economies, not for China, but for many emerging economies, the foreign demand for local currency denominated bonds in emerging economies is, I think, structurally very weak. To give you a couple of examples, in 2015, 20% of Brazil's local currency denominated public debt was owned by foreign investors. Now it's something like 9%. In 2018, something like 43% of South Africa's local currency public debt was owned by foreigners. Now that ratio is closer to 30%. When I put all of these factors together, weak growth, a deteriorating risk profile that results from rising debt, a kind of bias away from belt tightening, in other words, the sustaining of large financing needs going forward, and an unwillingness on the part of foreign investors to buy local currency bonds, it makes me think that the future of emerging markets policymaking is going to be governed by, let's say, 3 trends. One is that I think there's going to be a lot more dollar borrowing in emerging markets. I just want to pick up on something that Ayhan said. I mean, it was a beautiful presentation that Ayhan gave. The only thing I would say is that one of the things that I think characterizes emerging markets policymaking over the last 20 years is kind of an effort to get themselves as far away as possible from the crises of the 1980s and 1990s. There's this kind of, legacy of memory that has influenced economic policy over the last 2 decades, which means that countries have been trying to improve their dollar balance sheets. Because the one thing that was the universal truth about the crises in the 1990s and 1980s is that they resulted from excessive dollar liabilities. So countries have actually got quite strong dollar-denominated balance sheets these days. The Brazil, for example, is a net creditor in foreign exchange, that the government is. And we see that there is demand on the part of international portfolio investors to buy dollar-denominated assets issued by emerging markets borrowers. So from the creditor's point of view, the demand is there. And from the debtor's point of view, I suspect the willingness to supply that demand will also be there because, as I said, financing needs are going to be large for a long time. So increased dollar borrowing is one thing that I think may be a trend in the next few quarters, few years. The second is financial repression. What we've seen in countries, for example, in countries where international portfolio investors have disappeared, that disappearance has been kind of replaced by domestic banks that have been buying local government bonds. Now, they've been happy to do that because they're liquid and they've got nothing else to do with their balance sheet. But in the future, that may be less true. And I suspect that at the point where local banks might want to do something else with their balance sheet, governments are going to be more inclined to tell their local banks and the local development banks, we want you to own our bonds. In other words, you move into a world of financial repression. And a third trend that I think may be evident, which Ayhan also mentioned, is what is loosely called QE in emerging markets. Actually, in my view, it's not QE in emerging markets. In my view, QE is something that happens at the zero lower bound. And I mean, by that definition, there's no one in emerging markets doing pure QE. However, deficit monetization, which we see, for example, in Indonesia or Poland. In other words, we've got examples in Poland and Indonesia of central banks that are financing their governments and the sky is not falling in. And so more creative use of central banks' balance sheets, i.e. moving into a world that you could more characterize by the phrase fiscal dominance, is, I think, going to be another trend. None of this is good news. None of this, I think, is growth enhancing. And so I think in the end, we do go back very quickly, or very importantly, to the concerns that Ayhan was raising about the risk of debt distress in emerging markets in the future.
Thank you very much, and thank you for injecting some optimism into the discussion about China. I think some people will have questions, whether China isn't just one large credit bubble and a lot of misallocation of resources, and what they're now doing is they're compounding it. But let me ask you a question, that China's not going to save a lot of these emerging markets, particularly the large emerging markets. What I'm struck by right now is I'm watching two of the large emerging markets, both Brazil and Turkey, look like they're in the middle of foreign exchange crises, that their currencies are just dropping like a stone. And, I just wonder whether, what you're saying, sure that there's investment in dollar assets of these countries, but these countries already have got plenty of dollar liabilities. It might not be in the sovereign sector, but it's certainly in the corporate sector. Otherwise, how do we get to a number like $4 trillion that the BIS is throwing about in terms of dollar-denominated ways? I guess, and my concern is that the demand that you've got for assets right now in emerging markets, is just another example of responding to the very easy money of the Fed and the ECB. This doesn't mean that this is well spent. You're just kicking the can down the road, and you're creating for yourself a bigger problem, which is, I think, what Ayhan was saying. But I don't know whether you want to just say a word about Brazil, kind of how do you see that? It just looks like their public finances are as unsustainable as possible. You've got a deficit, you're running a deficit now, something like 17% of GDP, with a debt to GDP ratio of already getting close to 100%. This just looks like something has to give.
Yeah, no, I mean, absolutely. And I think, it's countries like Brazil and I would say South Africa as well, where the kind of options that I was setting out, some mixture of increasing dollar liabilities, moving into a world that's characterized by financial repression and a kind of, what you can describe as fiscal dominance, may well end up being the only policy options available to countries like these. Yeah.
So basically, Brazil ends up with another round of a lot of inflation.
Inflation is a very interesting phenomenon, because you may well be right. I can't sort of dismiss what you're saying, Desmond. But for the most part, with particular exceptions, Turkey, for example, Argentina, for the most part, emerging markets inflation is characterized mostly by how low it is, not how high it is. And that's largely because, I think because of or at least partly because of the legacy of the accumulation of monetary policy discipline that emerging markets have accumulated in their pursuit of inflation targeting, in the sort of the generally rigorous commitment that they've adopted to central bank independence. They've bought the phenomenon of monetary dominance, for the most part. And as a result of that, emerging markets inflation is not really homegrown anymore. Emerging markets inflation is overwhelmingly explained by global inflation, not by domestic inflation. Now, that might change. I mean, the World Bank's analysis earlier this year suggested that in emerging markets, inflation expectations are more likely to be shocked upwards by an increase in the debt GDP ratio than is the case in developed markets. And so I don't want to be dismissive about the risk that inflation in emerging markets might accelerate, but it might take some time, because many emerging economies are still enjoying this sort of accumulated, the credibility that they've accumulated over the last few years, which is keeping inflation expectations remarkably low. You know, particularly in a country like Brazil, where the nominal exchange rate has depreciated dramatically, as you say, it's kind of remarkable that inflation expectations are still so well contained.
Well, we might only be in the first innings, but with that, let me pass it on to Mark, and maybe you can give us, some indication of how this would be viewed from the IMF's perspective. What can be done about this?
Thank you for inviting me, Desmond. It's a pleasure to be here. I'm a poor substitute for Carmen. I hope many of you who tuned in to see her won't be too disappointed. The pandemic hit with a vengeance. Like in the 2008 and 2009 period, the world's reluctant lender of last resort, the Federal Reserve, stepped up and in March ended the sudden stop facing emerging markets and low-income countries caused by the immediate fallout from the pandemic. But as you just suggested, we're only at the beginning of the COVID crisis. We're going from a liquidity to a solvency phase. Emerging markets and LICs will face years of lost tourism revenues, commodity proceeds, and remittances. Their social safety spending needs have risen, revenues are plunging. They have less policy space in advanced economies, even if some have had some room for maneuver at this time. So the IMF stepped up as the crisis hit. It immediately pumped out liquidity support to low-income countries through its rapid credit facility and to EMs through its rapid financing instrument. It doubled access to those facilities. And by my accounting, it had dispersed about $40 billion of rapid finance to nearly 80 countries. So I'm going to talk about emerging markets and then low-income countries. On emerging markets, as I said, I think we're moving from a liquidity to a solvency phase. This is going to pose complex challenges for emerging markets. Even if the economic losses associated with the crisis are due to circumstances beyond their control, the impact is going to be enduring. And fairly or not, that means countries are going to need a mix of adjustment and financing to address the pandemic's consequences over time. In my mind, there are three types of EMs. First, there are Asian emerging markets and many Latins who are in strong positions. They have low debt and good, if not excessive, reserve buffers. Some have even undertaken some limited QE, as we were just discussing, though nowhere near the scale of advanced economies. They can stand on their own feet. The IMF has this platinum facility, the flexible credit line for them. Peru and Chile have tapped it. Colombia had FCL and is drawing on it. Mexico has one. Now, the fund has long fretted that strong countries during global crises run to the Federal Reserve rather than the IMF for swap-like facilities. The Fed had misgivings too about being put in this role, but the fund has finally managed to secure support from its membership for creating a swap-like facility, the short-term liquidity facility. The fund saw it as well suited to strong Southeast Asian nations. Alas, the fund built it, but they haven't come. Second, there are EMs already with clearly unsustainable debt or that will be pushed into unsustainability by the crisis. These countries need to restructure their debt, and they really should have IMF programs to help design a reform path, secure new money while the private sector steps out, and because the IMF can help set parameters for debt restructurings. I think the debt restructuring should be sufficiently deep to address debt overhangs. Now, I think the IMF could help do that by insisting on lower primary surpluses and programs, more realistic growth assumptions, lower debt GDP ratios, even lower gross financing need assumptions. I think in the current system we have, countries facing debt distress have an incentive to avoid clashes in reaching accommodation with creditors quite often. And the creditors have an incentive to minimize losses. And thus there's a tendency in restructurings to, and I think Ian was making this point, to basically just push out the liquidity hump, shift the repayments into the future, and lessen net present value losses. So I'm one for deeper restructurings. Third, there are the cases that are in between those two poles. These are countries that may face questionable sustainability, in my view, and they're going to need, in many cases, IMF programs. Now, the programs for such countries, in my view, should provide more liquidity support than is the traditional IMF bent, and even perhaps exceptional access, though not so much as to overload them with excessive debt. Now, this could be achieved, as far as I'm concerned, under existing IMF procedures, but the fund also might wish to consider, as I know it's doing, setting up a temporary special pandemic facility to do so, which could cordon off potential adverse precedents for lending in normal periods. The IMF has substantial resources on hand. The distribution of these is more heavily weighted towards backstop funding than to quotas, which are its first line. Of its touted $1 trillion in lending capacity is about 15 billion in remaining loanable quota resources. I think the fund should boost the role of quotas in coming years. Quota negotiations are slated to conclude in 2023, and they're going to be very difficult. I think the fund also needs to think creatively about what it will do if there is a wave of sovereign debt restructurings, which the traditional case-by-case approach using collective action clauses can't readily handle. I would just say, if creative thinking is going on, don't think for one second there'd be appetite in the United States for a global bankruptcy mechanism. Just one more word. China accounts for 16% of the global economy. Its weight in the IMF is 6%. Despite US-China tensions, China is a strong supporter of the fund, and both the US and China, I think, share a common interest in a healthy and stable global economy. I think were China to adopt measures on debt transparency and Paris Club principles, and I'll come back to that in a minute, I think the US should stand ready to signal that it would be open to seeing an increase in China's voting power in the fund and letting it become number two. Okay, so turning to low-income countries, they're going to be hard hit too. They're going to need programs and debt treatment. The IMF is seeking to raise funding to triple lending to low-income countries through its Poverty Reduction and Growth Trust, and to boost resources for debt relief through its Catastrophe Containment Relief Trust, the CCRT, which has been tapped by 25 countries so far in the pandemic. And I think this endeavor merits support. Now, my understanding is that many countries are ready to provide loans for this purposes. But the PRGT requires subsidy resources to pay down the gap between the loan rate and the PRGT lending rate, which is zero. And this effort, as I understand it, is not doing as well. I hope the United States, as part of any fiscal package, might consider contributing $1 billion to the IMF for PRGT subsidies and the debt relief fund. The fund could always, if needed, think about selling a limited amount of its gold holdings to generate such resources. As Ian mentioned, the key G20 IMF World Bank initiative for the low-income countries has been the Debt Service Suspension Initiative, the DSSI, a proposal to defer debt service for low-income countries now through the end of spring of 2021, with the aim of freeing up resources for social spending. I don't think one can be pleased by the results. I think that they're disappointing. Ian mentioned, I think 44 countries had tapped about $5 billion. The estimates that I saw suggested that total relief from the private sector and official creditors under the program could be about $23 billion. The private sector is not participating. Credit rating agencies suggest participation would be tantamount to a credit event. The private sector is telling emerging low-income countries participation might kill off capital market access. Eligible countries have been slow to take up the DSSI, fearing it would result in credit downgrades and wondering if a few months of debt relief, service relief was worth it. The participation of official creditors is spotty and confusing. So since the multilateral debt relief initiative of the mid-2000s helped wipe the slate clean, official debts have risen sharply to new non-traditional creditors, particularly China. Non-traditional creditors now dominate official lending. China's share of bilateral debt owed by the world's poorest countries to members of the G20 has risen from 45% in 2015 to 63% last year, according to World Bank statistics I think I got right. So when LICs in the past faced unsustainable debt, the Paris Club of official creditors would slash or eliminate them. Well, China and non-traditional creditors are not Paris Club members. Significant Chinese credits have been provided by the China Development Bank and the Chinese Export-Import Bank, as well as by state-owned commercial banks and firms. Though it is unclear, it appears that China Development Bank lending is seen as private sector lending by China and is thus being largely excluded from the DSSI. Whether China Ex-Im co-financing is seen as official or private is also unclear. And as we've heard earlier, beyond immediate debt service relief, much official lending to low-income countries may need to be written down or off. And while there's work being done on a common framework of principles for this purpose by the G20, my impression is it's only going to represent a step forward, but not a definitive forward movement. So multilateral support from the international institutions should not be used to repay the private sector, which should take responsibility for the risks inherent in its own lending. I think to that end, the official sector should develop approaches to make private sector DSSI participation mandatory. This would help countries avoid the perceived stigma of accessing the DSSI. Strengthened debt transparency is essential, especially from non-traditional creditors. The fund and the bank have far more work to do on this front. And then China has to step up. It needs to be fully transparent about its official lending to low-income countries. I think it needs to take a far more expansive interpretation of what constitutes official lending and it should apply Paris Club principles, and for all I care, we can call it Beijing Forum principles to its activities. So I will stop there in the interest of time.
Thank you very much, Mark, for that really comprehensive analysis. So far, what we've really seen from the IMF is that they're providing financing to the smaller countries, and it just sounds, the number sounds big, $40 billion, they've dispersed, but presumably that's been courtesy of the Federal Reserve, kind of easing as much as they have, that the larger countries haven't come to the IMF. You're anticipating that the larger countries will come, as we move to the solvency stage. And I guess if I understand you correctly, what you're finding with the IMF is that there's been somewhat of a imbalance between the IMF providing huge amounts of money and not enough debt reduction, with the idea that the countries get official debt and the private creditors get out. My question is, how practical is it, to change this balance, when you're talking about large countries that might have a systemic impact, on the global economy, that this isn't that straightforward, to get big debt write-downs, and without the bankruptcy court, it's not easy to do that at all. I was just wondering how you see that playing out.
So I think you're right that the fund's been giving a lot more money to smaller countries. I think you're right to raise the question you do. Again, I think that there have been some cases in the past where the fund has played a more proactive role in shaping the parameters of the debt envelope. I thought they did a good job in 2015 in Ukraine, for example. And so the issue is, as you know, if a country has to run a huge primary surplus, then it's more austerity and they have to generate more resources to give to creditors. And if it's a smaller primary surplus, it's less austerity and more resources, shall we say, at home. And so the question is, what's the right bounce? As I outlined, I think that countries facing debt distress have an incentive to undertake preemptive restructurings or quick restructurings afterwards, and to try and normalize relations with creditors. And politicians have an incentive in a way to do that, because if it gets really ugly and the economy tanks, that's bad for them. So I think they're inclined to just go along and push out the hump. I think that the private creditors don't want to take NPV losses or to minimize the NPV losses. They have an incentive. So I think the game right now is such that it's not resulting in sufficiently deep restructurings. Now, the IMF can play along with this and massage its spreadsheets to bounce out these forces. But then the question is, what are the realism of the assumptions? And are you getting rid of the debt overhang such that if the country were to perform well in the future, which is always a big if, could you put that country on a better track going forward? And that's where I think it is not unreasonable to think that the fund could be in there pushing for lower primary surpluses, not requiring huge gross financing needs to go towards interest service, and trying to get the debt to GDP path down further. So that is how I see it, Desmond.
Well, no, thanks. But I guess, just like with the experience of a country like Greece, that makes it really difficult, that its shareholders are reluctant to allow the IMF to do that, because then it's got implications for their financial systems, their banking systems, and so on. So it's kind of a difficult.
It is, and I didn't say it would be easy, but I think it's worth pushing.
No. I very much agree with you. Because I think that was Ian's point. That if you don't sort these things out up front, then what you just have is you have multiple debt restructurings over time, and in the process, you get these countries to lose a decade or two.
Absolutely.
That brings me to Steve.
Thank you, Desmond. And let me pull up my screen here. Here we go. And everybody see that?
Yes.
And,
yeah.
All right, good. So thank you for inviting me to share my views on prospects for U.S. interest rates and their implications. Hold on a second here. Whoops. Oh, great. Which I have, hold on, I want to get this right. Good. Which I've labeled the good, the bad, and the ugly for emerging markets. So as several of you folks have already discussed, even before the pandemic, emerging market vulnerabilities and debt were climbing, and that put them in a very bad position once the pandemic hit, and global financial markets were roiled. As you can see here, starting on the left, the dollar shot up against emerging market exchange rates in March and April. CDS spreads blew out, and equity prices collapsed. Fortunately, that turmoil didn't do too much damage because it subsided so quickly. And in fact, the major emerging market economies still managed to regain access to international capital markets. And according to IIF, basically bond issuance by EMs held up reasonably well this year. Now, this calming of financial markets, as you all have pointed out, reflected massive fiscal stimulus, some indications the pandemic was slowing, and probably more importantly, overwhelming monetary stimulus by the Fed and other central banks. Okay, and as you can see here, the blue line, the Fed funds rate plunged to zero, and longer-term Treasury yields, the black line, also declined very rapidly, reflecting both expectations of continued monetary stimulus as well as flight to safety flows into U.S. Treasuries. And these low rates are critical, all right, because they reduce the burden of external debt service, And that makes higher yielding EME assets, and it makes EME assets that are higher yielding more attractive. And altogether, that makes it easier for emerging market borrowers to roll over their debt and avoid default. So the emerging markets seem to have avoided, dodged a bullet, at least for now. But many observers, and by many observers, I mean Desmond, have raised concerns that once the pandemic gets under control, the economy recovers and interest rates start normalizing, that emerging market borrowers will run into trouble. Now, I don't believe that's a foregone conclusion, and so I want to just review some different scenarios for US interest rates to see what happens. So we'll start with the good scenario, if that's clear enough. And in it, and I should note that this scenario is broadly speaking consistent with the baseline forecast of the IMF and other World Bank and other agencies. In it, the pandemic comes under control by next year. The economy, continues its recovery from the plunge earlier this year. And importantly, inflation rises only gradually, kind of like continuing its subdued behavior, of recent years. Now, in the past, economic recovery would have prompted concerns about a tightening of monetary policy by the Fed that triggered adverse spillovers to emerging markets. But this most likely will not happen in this current situation, and for a couple of reasons, all right? So the first of these is that consistent with the Fed's newly announced strategy of seeking some overshoot in the inflation rate to make up for past shortfalls, as well as to refrain from tightening in response to low unemployment, as long as there aren't any obvious inflationary pressures, the Fed funds rate would probably rise only gradually in these circumstances, and we'd expect that longer-term yields would also move up only relatively slowly. So here I've concocted an illustrative scenario to kind of like show what I'm talking about. In it, the dashed blue line is the forecast for the Fed funds rate, which is taken straight from the FOMC's own survey of economic projections, and it remains flat throughout 2021. The 10-year Treasury yield, follows a path that starts out as implied by the current Treasury yield curve, but I've added 50 basis points toward the end, so it goes up to 1.5%. To reflect the likelihood that it'll move up as low for long interest rate scenarios drop out of financial market expectations. But either way, what you can see is that these interest rates remain super low and thus not as worrisome for borrowers. Now, I have a second reason for optimism as well, okay, which is that even if interest rates rise faster than currently anticipated, they're likely to be fairly benign as long as they're driven by faster economic growth rather than high inflation, okay? And the reason for that is that higher growth in the States leads to higher exports abroad, better balance sheet situations for foreign governments and firms, bolsters debt service capacity, and that, of course, offsets the effect of additional interest payments. So what I'm showing on this page is the results of research by myself and a couple of my Fed ex-colleagues, Jasper Hoke and Emery Yildiz, in which we contrast the effects on emerging markets of US interest rate hikes that are driven by improved growth prospects with US rate hikes that are driven by higher inflation, okay? And so those bars represent the econometrically estimated coefficients or effects on emerging market asset prices of a 200 basis point increase, surprise increase in US Treasury yields. Depending on whether that increase reflects a growth shock, that's those blue bars, or an inflation shock, that's the red bars. And as you can see, a rise in US interest rates that's driven by an inflationary shock, again, that's the red bars, leads in emerging markets to sharp currency depreciations, that's the top left panel, sharp widenings in credit spreads, the top right, and skipping one, going to the bottom right, to large declines in emerging market equity prices. Conversely, looking at those blue bars, if a US interest rate surprise is driven by a growth shock, it exerts negligible effects on emerging market financial assets. And I'd be happy to talk later or offline about where these shocks come from in terms of how we identify them. Now, to be sure, this doesn't mean that there will be no emerging market defaults in this good scenario. A couple of countries, Argentina and Ecuador, have already defaulted or restructured. And I would expect this year's global recession to push a few more of the more vulnerable EMEs into difficulties. After all, in all Clint Eastwood movies, even the good guys are not all good. Okay, so that's the good scenario. But lest you think I am hopelessly optimistic, I have not one, but two bad scenarios, okay? And so the first one is obviously suggested by the spillover estimates that I just showed you, okay? Which is that as in the good scenario, the pandemic eases by next year, as an effective vaccine is disseminated and economic growth recovers generally as expected. But inflation in the US and around the world surprises on the upside, possibly reflecting the supply side shocks of the pandemic, but in any event, and this is very important, boosting inflation expectations, okay? So in this scenario, okay, the Fed funds rate, again, the blue dashed line, rises not that quickly, only a little bit faster than currently expected, held down by the Fed's desire to again allow some overshooting. But the combination of higher expected inflation along with the return of a positive term premium pushes US 10-year Treasury yields up to 4%, way above what people are now expecting. And in the way of a self-fulfilling prophecy, this surge in interest rates adds to emerging market debt burdens and reduces growth. And as you can see here in these equally illustrative illustrations, leads to sharp currency depreciations, widening of credit spreads, again, equity collapse, and altogether a shortfall in refinancing that triggers widespread defaults in emerging markets. So that's the first bad scenario. And the second one is associated not with a spike in global interest rates, but in fact their implosion, which is basically a sharp resurgence of the pandemic. And I hope that's not what we're seeing these days, but we'll see. Throws the global financial markets back into turmoil, okay? And in the situation, long-term and short-term interest rates fall all the way to zero and stay there. But this doesn't really help emerging market borrowers much because there's a giant spike in risk aversion among global investors so that again, currencies depreciate, credit spreads widen out, equity prices fall. And again, you'd expect some wave of default by emerging markets. All right, so that's the good and the bad. We have one left, the ugly, okay? And in this scenario, there's neither steady economic recovery nor a catastrophic resurgence in the pandemic. Instead, what happens is basically that unexpectedly slow progress in containing the disease, possibly reflecting difficulties in developing or disseminating the vaccine, leads to a prolonged global recession through much or all of next year. So in this obviously ugly scenario, US interest rates pretty much tread water at these very low levels, for most of the rest of my forecast period. But basically, the fact that economic growth remains so subdued, leading to weak exports, et cetera, puts, again, the more vulnerable emerging market economies under pressure. And so, which countries might those be? Well, we've heard a little bit about that. And just out of curiosity, I asked my research assistant, John Kearns, who did a great job, thank you, to plot the following scatter plots. Along the x-axis is the change in sovereign debt from 2019 to projected in 2021. That's projected by the IMF as a percent of GDP. Along the y-axis is the change in the dollar interest rates since January of this year, calculated as the US Treasury yield plus the CDS spread I showed you earlier, okay? So most of the countries in this scatter plot, okay, are ones where government debt is a lot higher than before, projected by the IMF, but the dollar interest rate has fallen since January, reflecting the fall in US Treasury yields. So for those countries, debt up, interest rates down, it's not obvious what the implications are for debt sustainability. However, we do see 3 countries where both the debt has risen and the interest rate has risen: Turkey, Brazil, and South Africa. And interestingly, those are the 3 countries, or among them, that have been mentioned earlier in our discussion as being ones that are particularly vulnerable. So obviously, in the ugly scenario, as well as in all scenarios, they bear close watching. So to wrap up, your final figure summarizes these, the scenarios that I've described, along as the completely arbitrary and made up probabilities that I've assigned. 50% for the good one, 10% for the inflation shock, and 20 and 20 for the pandemic resurgence and ugly scenario. Okay, so to reiterate, a normalization of global rates that triggers a wave of emerging market defaults is not preordained. But on the other hand, 3 of the 4 scenarios are not so good, to say the least, and they account for half of the probability space in my highly scientific estimation. So I think there's plenty of cause to worry about these. So thank you very much for listening and watching. Grazie. And I will now turn this back to Desmond.
Thank you. Ian, would you like to comment on, do you have any comments to make on Steve's assessment of global outlook?
I like what Steve said, and I'm happy that he put 50% probability for the the good outcome, and I think his risk assessment right on target. And I appreciate the fact that he showed us some impulse responses. That's good to see. If possible, I'm going to talk a little bit about certain new policy challenges we need to really think carefully as we are assessing the kind of the debt risks going forward. So I talked about the characteristics of these debt buildup we all know in the 70s, 80s, and 90s. This episode we are going through raise some new challenges, and these challenges make the kind of the achieving lasting debt relief even more important. The first one is the fragmented creditor base. So in the event of a debt crisis, its resolution will likely be much more complex than in earlier crises, since there are many creditors with diverse motivations. Paris Club bilateral lenders, non-Paris Club bilateral lenders, including public-owned policy institutions, and private sector lenders. And as some panels mentioned, the importance of bilateral non-Paris Club lenders has increased substantially, and China is now the largest official creditor to developing countries. Second issue we haven't touched in detail so far: lack of debt and investment transparency. Since not all creditors are bound by a single set of reporting standards and loan terms, the growing diversity of creditors has been associated with greater uncertainty about the level of composition of debt and its use. And there are, of course, as the third item, the governance shortcomings. Over the past decade, even more so in 2020, low interest rates have been an incentive to accumulate additional debt. So some emerging developing economies took advantage of this low rates environment to improve the structure of their debt. But some of this borrowing, of course, was also needed to, finance pandemic-related emergency spending. However, it is also likely that some of the increase in debt was not used well. This was especially the case prior to the pandemic. So restraining borrowing is often a political economy problem. And I think that this political economy problem has deepened over the past decade in an environment with very low interest rates. And finally, let me talk about global debt resolution practices. In several dimensions, the playing field is currently tilted in favor of creditors. And it discourages prompt and comprehensive debt resolution. We need to address some of these issues quickly, but it's going to be very difficult with the current frameworks we have. There is, of course, this idea that you have collective action clauses. It's true that since 2014, 91% of sovereign debt issues has included these types of collective action clauses that facilitate restructuring, but still a large legacy stock without such clauses remains. About 50% of outstanding international debt does not include collective action clauses. So all in all, there are significant challenges in the context of the stock of debt, and there are significant policy challenges, making resolution of the the debt challenges we have more difficult. So when you put all of these together, it is critical for the global community to get together and address the these large challenges. But let me stop there. Thank you.
Thanks. I want to just give everybody a chance, just to say a concluding word at the end. But before that, I'd just like to clarify something with Steve. So you're agreeing that even if you don't get a rise in US interest rates, you don't have the temper tantrum that we had, when Bernanke talked about it in 2013, you could get emerging market problems if we had risk off occurring in the global economy, and that could be precipitated by a second wave, the kind of second wave that we're seeing in Europe, that we're seeing in the United States right now. It looks like this is out of control. The health experts talk about a very dark winter, in terms of the disease. Presumably that can precipitate problems for the emerging markets, which are currently now enjoying ample global liquidity. Everybody's got the risk on trade, but if the risk off trade comes, we could bring forward the date at which we get a crisis. That's the one question I had for you, Steve. The other is, you don't mention the risk on the fiscal side, that it just seems that what's occurring in the United States, and globally, is there seems to be no constituency for fiscal discipline, so we could be off to the races. We happily talk about a $2 trillion package. No, it should be $2.4 trillion, as if these aren't really very big numbers. And I guess that can influence the way in which interest rates look going forward, that markets already pricing possibility on the long end of the curve, that things might not look so hunky-dory in 2021.
Right. Thank you, Desmond. So first, to your first question, you're absolutely correct in terms of the interpretation. So yeah, a second wave of the pandemic could, in principle, trigger a huge rise in risk aversion that basically leads to sudden stop in capital flows to emerging markets, and terrible things happen. Now, I mean, that scenario would face a little bit of an uphill battle, in the sense of, number one, we've all gotten used to the pandemic already, and that has a tendency to make future bad events less biting. And secondly, it would have to fight against all the monetary ease that we're already providing. But, I mean, we could have a resurgence that was multiple times what we're now seeing. And in that situation, markets might decide that the end is near, and and take that dive. On the fiscal front, I focused on the near term, which is to say the next year and a half. Okay, and in that time period, certainly for the advanced economies, I don't see fiscal debt rising to a level that would disturb the markets, because there's no other borrower around. And what we've seen in the course of the last decade and a half, basically, is the advanced economies, as long as they can print their own money, they have lots and lots of scope to issue debt. And in a situation that looks like secular stagnation, they can issue debt very cheaply. Going down the road, other things could happen. Now on the emerging market front, as I've said, looking at the calculations as they are right now, projected increases in their fiscal debt seem to be offset by declines in the interest rate they have to pay on it. But, toward the end of next year, it could be apparent that the interest rates aren't going to go down anymore, but the debt is going to start rising or keep rising. And so again, you could see problems down the road. But I'm presenting scenarios like just for the next year and a half, which is well beyond what anybody can really predict.
Thank you. Maybe if we just go around the table, in the order which we spoke, if you want to say a last word, in reaction, just leave us with your final thought. Ian, would you like to begin?
Yes, let me thank you again for this invitation. I think the kind of diagnosis is here clear. And reasonable people can disagree on the margins of the solutions. We need a major policy effort in place to address the debt problems in the poorest countries we are seeing around the world. While we are doing that, we need to be mindful of similar problems unfolding in the near future in other emerging market economies if we have a protracted pandemic and low growth environment. So currently, solvency problems are concealed by historically low interest rates and investors search for yield. Once interest rates rise or investor sentiment turns, what may start as a liquidity crunch might rapidly reveal a solvency crisis. So to avoid a bout of disorderly, widespread restructuring negotiations, proactive efforts at debt relief are needed. And that's, our hope from the global community in terms of the kind of the policies needed to put in place. But thank you again for the opportunity to talk.
No, on the contrary, thank you. David, would you like a last word?
Yeah, thanks, Desmond. I just want to say something that maybe is slightly more optimistic about the external debt position of developing countries. I mean, or at least it's something that could be buying us time to get to the kind of solution that Ayhan was discussing. The increase in debt, the increase in external debt, is mostly an increase in gross external debt. When you look at the net international investment positions, in other words, the increase in external liabilities minus external assets, the net IIP of most emerging economies has not deteriorated much over the last few years and is actually not high by historical standards. That's the stock. In addition, when you look at the flow, when you look at, for example, debt service ratios up until 2019, they're also not high by historical standards. Now, of course, the picture has changed because of the export collapse in 2020. But the point that I want to make is that emerging economies may still have some time. And in a way, the fact, what I'm describing, the fact that both stock indicators and flow indicators of creditworthiness are not that stretched, helps to explain why international portfolio investors this year are so hungry to buy emerging markets bonds, because they don't perceive huge creditworthiness problems in emerging markets at the moment. And emerging economies themselves have reason to be relatively optimistic about their market access, which helps to explain why only 3 of the 70 plus countries eligible for debt relief under the DSSI have asked for private sector debt relief. So we have time. I don't know exactly how that time should be used, but the combination of relatively, at the moment, unstretched external creditworthiness problems in EM, together with the very low likelihood of monetary tightening in the United States at any time in the near future at least buys developing countries time.
Thank you. Mark, I guess we're running out of time, so we'll make Mark, you're going to have the last word.
Well, thank you. And watching Steve's scenarios, I probably instinctively would have tended more towards the less beautiful scenarios. And I couple that with David's opening presentation. I have a less sanguine view of China. I think that the sustainable growth rate in China is going to come down substantially over this decade, as you said. And I think that when you couple that with the growing statism, the recourse to investment in SOEs to support growth, that it's building up financial leverage and is going to make the economy's sustainable growth rate path even potentially bumpier and lower. And when you couple that with the world in which Japanese potential is extremely low, Europe's is low, the US is coming down, I don't think it adds up to a very pretty picture, and it leads me to the same place where Ian ended up, which is that we really need a good policy push and we need greater cooperation to address some of the challenges we're going to face, not only now, but as we get out of the pandemic.
Terrific. Well, it just remains for me to really thank the panelists for, what I thought was really kind of a fascinating discussion. And it really was very good to get different perspectives, and maybe I'll come back and ask you to do this again in 6 months' time, to see where we all are. But thank you very much. And to those who've been tuned into this, thank you for watching.
Thank you.
Thank you.